Welcome back. Here with us on Trading Hour, and joining us now is a banker who rarely speaks, but today we've managed to catch him. And we're talking about one of the largest private banks of the country. Axis Bank is, of course, what we're looking at. And we have with us from the sidelines of the Axis India Conference 2024, Rajiv Anand, Deputy MD at Axis Bank. Rajiv, great to have you on the show. Thank you so much for taking out the time and joining in. So we speak to you at a very, very interesting time, right? There are several burning debates in the banking world today. There's a burning debate on the fight for deposits. There is a debate on the RBI getting very, very active with respect to regulation. And then, of course, there's the usual sort of chatter about liquidity and margin management, etc. So I'm thinking which one to start with. Let me actually start with the whole concept of fight for deposits and what lies ahead. And I'll tell you why, because that is a new reality that the stock market woke up to after looking at the third quarter. Right? For most of the banks in question, we've seen a slight compression in margins, Axis included, though you've done so well on mobilizing more deposits, probably the best in the system in the third quarter. So what lies ahead with respect to this fight for deposits? Will it remain difficult? And then what bearing does that have on bank margins?
Thank you for having me, I love the way that you articulated the issues that a banker is grappling with at this point in time. I think liquidity is tight at this point in time for a reason. I think the battle against inflation isn't won yet, is basically the message that RBI is giving us. And if you look at some of the uncertainty that we have seen, or volatility that we have seen with inflation numbers, even in the US, I think the circumspection is in that sense justified. And to my mind, unless we see the US, cut, then liquidity begins to ease off just a little bit from a global market perspective. There doesn't seem to be any compelling reason for RBI to either cut rates, and I think that is certainly off the table anytime soon, to ease liquidity. At least, let's take this 6 months at a time. I don't see liquidity easing off, and therefore the liquidity premium that banks and markets are paying is actually quite elevated at this point in time.
So to come back to the question, Rajiv, what does that mean with respect to margin pressure? I mean, we've started seeing the first sign of that in the quarter gone by for almost all lenders. Axis saw, relatively, I think, lesser of a hit, 10 basis points thereabouts. But does it get more severe down the year? And then the whole fight for deposits. I mean, how do you maintain your margins if this fight for deposits will keep being, what it is today?
Ultimately, a high-quality bank is built on the back of a high-quality liability franchise. And that gives you the ability to, in a sense, take on a lower risk-weighted asset portfolio and to be able to deliver NIMs. And that's the, sort of, in a sense, the bedrock of, everything that we are trying to do. If we find that we are not seeing enough deposits coming through, we will have to make a choice in terms of how we are building the asset book, building for the long-term franchise at one level, but also managing NIMs and ROE in the short term. And so therefore, we will make choices in terms of which assets to put on as we go forward if the liquidity situation continues as we see it. And I do anticipate that if we broadly believe that deposit growth will be anemic going forward, it is inevitable that you will see some slowdown in credit growth as well going forward.
Okay, so deposit growth will be anemic and therefore credit growth is going to be under pressure. Do you want to put some numbers to this, Rajiv? What could be the deposit mobilization, the deposit growth that you see in FY25 and therefore the credit growth also? So
our economics team is currently penciling in deposit growth in the vicinity of about 13% for 24-25. And I think, if it is also important to see what is the composition of that 13%. And I think we need to see, whether that money is coming through in terms of longer term deposits and non-retail term deposits, or we continue to see at least reasonable growth in current and savings accounts. But broadly speaking, we are currently penciling in 13%. And assuming that that cost of funds continues to be where it is, I think it is possible that we will see asset growth beginning to slow and tend towards 13% as well.
Asset growth slowing to 12 to 13%, and I guess that's in sync with what the RBI has been hinting at as well, Rajiv, because we've been obviously chasing that story about the credit deposit ratio and how it seems, and in my colleague Ritu's conversations with Mr. Chaudhary as well, I think the indication was that while there may not be a specific prescribed limit on the credit deposit ratio, is there an indication that banks need to lower it down to some sort of a ballpark threshold? Where are we on that?
I don't think the RBI, obviously the RBI is having conversations at a systemic level and at an individual bank level. And I don't think they are currently prescribing any number which is good. And I think it is important for banks to listen to the tonality of RBI. What they're basically saying is that it is unacceptable at this point in time to have a high CD ratio, and that high could be different for different banks based on the quality of the deposit franchise, the way the liability stack is looking for each individual bank. But the fact remains that I think it is very clear from the RBI that that a high CD ratio at this point in time is something that should draw the attention of senior management and the boards of banks.
So let me, ask you a little more on this. We saw the regulatory norms with respect to higher risk weights, this whole focus on unsecured lending. So when we're talking about not having a very high CD ratio, which are the areas where perhaps, banks like yourselves, if at all, will think of applying the brakes? So would it be on the unsecured side? How will, most of the banks ensure that they remain within the so-called high limit that the regulator is comfortable with?
There are two separate issues that we are currently grappling with. I think the RBI has highlighted the fact that they want to slow the growth of unsecured, and therefore they have increased risk weights for unsecured loans, and as also they've increased the risk weights for bank lending to NBFCs just to manage the any collateral damage that could potentially play out from the NBFC side as we go forward. A classic counter-cyclical move that we have seen from the RBI. And so therefore, I just want to put it in perspective that a bank like us, 80% of loans that we do on the unsecured side, typically personal loans and credit cards, is to existing customers of the bank, and two is by and large it is to salaried employees, and therefore we are quite comfortable in terms of how risk is playing out within these portfolios. Having said that, we have seen that the proportionality of unsecured incremental unsecured disbursals has come off in the previous quarter. But I also want to put it in perspective that for a bank like us, if you look at the overall portfolio, it is only 14-15% of the overall portfolio which is unsecured. And I think one of the things that you will also notice is that the RWA intensity for the bank has been more or less stable, notwithstanding the increase because of the increase in risk weights, has been more or less stable, meaning that it is not as if the bank is taking on a higher and higher level of risk to be able to sustain or maintain NIMs at this point in time, and that will continue to be our philosophy as we go forward.
Rajiv, you said the proportion of incremental unsecured lending is moderating, and you've already seen that in Q3. So how much has it disbursement? So how much has it come down by in Q3, and are you looking to moderate it? And although at a broad level, the asset quality may be fine, but relatively, are you seeing some deterioration on the unsecured side in your book?
The numbers, if I remember my numbers right, I think it used to be 25%. It's come down to about 22% in the previous quarter. I want to once again reiterate that we are quite comfortable in terms of how risk is playing out on the unsecured side in our portfolio, meaning that we are not seeing anything that is alarming, and that the risk is playing out, relative to the pricing that we are able to get within this portfolio.
Rajiv, that's for your bank. What's the gut feeling you're having for the sector as a whole? I think that's the question that's on everyone's mind, including, of course, the regulator.
I think if you look at most of the large banks, if you look at the numbers in the last quarter, including most of the NBFCs, at least at this point in time, we are not seeing any risk build up within this portfolio, even at a systemic level. But I think I do take the point that the RBI is making, that it is important for us to fortify balance sheets, ensure that that risk is not being written, lower levels of risk is not being written in the best of times, because you certainly don't want a situation where today's NIM becomes tomorrow's NPA.
Rajiv, great conversation. Thank you very much for joining in today. We need to slip into a very short break on that note. On the other